Welcome to the next lesson about key levels. I use few types of key levels. The first ones are volume spikes based on the volume profile tool. Then point of control, also based on the volume profile. VWAP with deviation bands. Value area high and value area low. And OHLC gaps based on footprint chart, but just a bit. Even if we are still before the footprint chart lesson, I just want to show you visually how to spot these levels. I don't even know if this is correct term. This is my own words, how I just call this. And for me, these types of key levels are better for TPs. You can still look for entries there. I'm also doing this sometimes, but really very occasionally, and spontaneous entries. But the biggest probability of a good setup will always be from the supply or demand. This is just based on my experience. I prefer to find a good absorption inside the zone and then TP on one of these levels. Of course, the best situation is when some key level, or sometimes even two key levels, are inside our supply or demand. It is kind of double confirmation or even triple confirmation. I mean, for example, the volume spike inside the demand, or even better when the VWAP is also going to this zone. That is the very high probability that the zone will hold the price. So let's start with the volume spikes. I have here an example on GC contracts. So this is the gold chart. And volume profile, what it is. We have this here set from each day. I use daily volume profile, and it displays the trading activity. It shows the total volume traded at each price level. So there are sometimes lower activities, sometimes bigger, and all the bigger we can see as spikes. I call the spikes, so the biggest volume was traded in this price level. Then it was lower, again big, lower, again big. So I mark these levels every single day because these are important for me. Sometimes it can be easily broken, like for example here. So I don't use this in 98% of cases as an entry just for TP. If I'm shorting gold, because here we can spot supply zone, price came there, lost volume, and probably there were news, red folder news, and then was just very big short through the key level. But sometimes it's just bouncing from the key levels, yes? So what I'm doing, if I'm trading, for example, it is this day, somewhere here, the beginning of the London session, I'm just marking the key levels from the previous day or days. Yeah, sometimes these are from 2 days, 3 days, but I'm not focused on too old zones or levels. Maybe sometimes if price is reaching new highs, really new highs after a while, I can say that, okay, here my TP was in the volume spike from 2 weeks ago. Yeah, because until this time the price didn't reach it, but usually I use 1 or 2 days back the key levels. Let's see the next slide. Okay, here is the ES, my favorite asset. So also the same, yes, the highest volume from the previous days, and these are really nice TPs. So sometimes price is really trying to bounce from it, but as I said, I'm not using this as entry, better as a TP, because the bounce was very small here. do not be disappointed why it didn't hold. This is just like price is going in this example up and looking for a next supply on the way, yeah? Next resistance level or area to look if maybe here there are some resting orders. If not, price is still going up. So this is why it's a good TP, because based on the previous historical data from the previous day, the aggressive traders, we all are aggressive traders. We're using market executions mostly, okay? So we can think that with a high probability if there was in this price level the biggest activity previous day, maybe there are some resting orders. So they are testing this, looking for them. If not, yeah, we are going to another volume spike to check if there are maybe some resting orders. So here was a nice example, because here we have supply based on the candlestick chart, supply based on the volume profile, and here is also volume spike. And here the aggressive buyers found the passive sellers. But about absorption, I will talk to you later. So here was another nice distance between two key levels. It was like 10 points. Yeah, so it's really a lot. Usually what I'm catching on ES is between 4 to 6 points, sometimes 5. Sometimes I'm scalping just for 2. So really 10 is a lot. This is very nice distance to catch. So these key levels are one of my favorite ones. Yeah, the volume spikes. Next, the point of control. It is also based on the volume profile. It's one of the additional tools inside this package. And it is the price level for the time period with the highest traded volume. And it's changing during the day. Yeah, so here was the first high volume traded, in this case 6B, yeah, GBP USD, in the Asian session. Then when the price was falling, more volume came, then changed, even bigger volume, etc., etc. And here when during the early London session, I'm just guessing, yeah, here's the first high volume, so I expect that here is the London session, was the highest traded volume. And as we can see, this point of control was valid until the end of the session. So this whole rally in the New York session didn't bring bigger traded volume. It was just a rally. Here was range, so probably because of this the volume accumulated. But here we have beautiful key level which was reached the next day. This example shows beautiful rejection. Maybe here was some absorption, but as I said at the beginning, please be more focused on trading, on finding at first supply and demand. Here we could say that here was demand based on the big volume, big trade tool. Also volume was high here. So here we could say that it was demand. But at first we need to find the zones, then key levels. Okay, so next slide. This is the VWAP. The VWAP means the volume weighted average price. It looks very similar to the EMAs, but here, if you change the time frame, this line will still be same. We all tried probably the SMAs, EMAs, the crossing, a lot of strategies. But if you are setting something on M15 and then you change the time frame to M5, the EMAs also were calculated for this new current time frame. And by the VWAP, it is always the same. On the 4-hour chart, on the M15, M5, M1, always this is the average price. So yeah, it represents the true average price for on the market. So usually start from the beginning of the session of the day and until the end. So the 23 hours of data is collected here. So by adjusting volume to, for example, so-called EMA, it is more accurately, it more accurately shows the impact of larger trades than traditional moving averages. And there are two schools of how to use it. The first school says that when the price is below the VWAP, the trader's bias is bearish and they are looking only for shorts. Yeah, so for example, here is kind of maybe supply, price was always below the VWAP, price reached it again, so the short is, the bias is still for looking for shorts. And again, if price is above the VWAP, this school is saying that the bias should be finally bullish. But second strategy says that if the price is below the VWAP, the investors got probably low enough price for a buy and they want to deliver it back again up. And again, secondly, if the price is above the VWAP, could mean that the price is high enough and the big guys could be ready to sell to get back the average price. So two different ways of understanding the VWAP, and with all honesty, at the beginning of your journey, I would advise to stick to only one way. Both are logical, both are good, but if you have less things to look for and to analyze less, to find a bias, it's better. Yeah. My understanding is closer to the second school, that if I am below the VWAP, I prefer to use it as a TP, as my key level, to find the potential risk of reversal, because maybe the guys from the first school want to short here, because price is still below. So I use them as a TPs, but here's something important to remember. It's one of the most common myths about VWAP is that the price is always attracted by it, and this is false. Most of cases, okay, yes, the price will reach the VWAP, but the big guys also know this, that if we are using one of these two schools, we want to close or open the trade on that area. And it happened, for example, here. The London shorts reached the previous VWAP and price tried to bounce up, but as you can see, 3 times it missed the VWAP. So if someone took a short here, sorry, not short, but long here, it could miss his TP and maybe close the trade at the break even. Or if someone was waiting for a sell from VWAP, he could miss the opportunity. Yeah, so maybe the price bounced here because of another key level, like point of control. Yeah, this sharp London short broke the previous low and probably a lot of volume came here, and who knows, maybe the point of control came here, or some imbalance. Or really the high volume is my biggest probability here. So that's why price wasn't able to break it. That's why I missed the VWAP. So if we have marked some key levels on our chart, try to not like catching the home runs, really, not few beautiful big trades. Just try to reach the first key level on the way, because no one can predict if this key level will hold or not. For some reason we call this key levels. So if a high volume spike is here, or point of control, and the VWAP is above, So why the hell we want to see the price at the VWAP if another key level is on the way? Yes, so this is just my advice. Yeah, I'm giving advices, but I'm also doing this mistakes sometimes. This is this little devil in our mind which says a lot about greed. We can break this level, we can reach another one. It's not always truth. So be aware of this, please. Always safest trades are to the nearest key level on your way. Really do not try predict of breaking this key level. That's why I use them as a take profits. It's good to mark all of them to see if the entry is worth the risk. Yeah, because if I want to enter. I just don't see the good example. But if I want to enter, here, and I have some stop loss set to 15 pips, but 10 pips above my entry is key level, and 15 pips above another one, it's not worth, because my risk is bigger. My safe setup have bigger risk than the nearest key level. So if I'm risking 15 pips to get 10, and maybe 25 pips another key level, I cannot think maybe the price will go to the another. So this is not worth setup of the risk, so I would leave it. Anyway, I would just leave it. Okay, I talked too much about this, sorry. And I hope you can find some nuggets in this this longer talk or speech. Now the topic of full volume weighted average price with deviations. So this is the VWAP with deviations, and these are kind of bands on our chart to create I would call this visible unit of measurement. So these are plotted alongside the VWAP, automatically adjusting as more data is received. So in the beginning of the session, the range is very thin, and then it becomes wider and wider and wider, so bigger range. So that I don't use the Asian session or London session. I don't even like to watch these candles, because the biggest trading activity is when the stock market is open, so 1.5 hours after New York, and then the ranges are bigger. Let's zoom this part only, and you can see here, the pre-market had just 3 points range, and then later on it was 4 points, 5 points, and almost at the end of the session, the very late New York, it was 6 points. So if someone could find entry on this supply zone, this was the range, equal highs, liquidity grab, break of structure, so that left the supply. If you found here entry, the deviation at the late New York session was a good TP to catch 6 points. Here's also demand zone, even one bigger demand zone. But really, I love not to guess by marking some candlestick zones or something like this, or looking for fair value gaps, so-called fair value gaps. I'll explain this later. I use facts. I don't love to guess. I'm not guessing if some key level will be broken or will hold. I'm just marking this and close my trades at key levels. So this is also the fact. Here's the first deviation of the VWAP, and if so, I want to close the trade. I don't want to predict if the price will go lower. And 6 points on ES is really good wave. Believe me, the 6 points is good, even if you use 3 points stop loss. Yes, this is 2-hour trade. Then we have value area high and value area low levels. So what is value area? Simple words, this is this. In the middle. This is an area where the most buying and selling volume took place, and I have here highlighted in the blue color the 68% trade area. This is my setting. I didn't change this because some traders use 70%. To be honest, I just left default setting. I don't know if the 2% makes some difference. I don't know why some traders have such a setup. I use default, yeah, 68%, and I'm marking this as also as a key levels. So the highest row in value area represents the value area high, so VAH. And the lowest row, so here and here, yeah, this is the value area low. And yeah, as I said, these are key levels, but honestly, I mark them, but I don't use them all the time, because usually I'm trading the first part of the session, where the price is usually still on the value area, and I'm just aiming for volume spikes or other key levels. Yeah, only sometimes really in the session the price is going definitely to the high from the previous day, and then it's good to have such a key level as a TP. So in theory, okay, I am looking for a buy here, so I am not aiming for this high, but for key level, for value area high. Yeah, this is what I changed long time ago. I used to aim for a wave or daily, or yeah, usually wave highs and lows. But very often the price is interesting on the highest or lowest value area from the previous day, week, or few days. So not always the price is reaching the high. And I think that all of us have experienced this, that we are aiming for some really good looking price level, and then price is reversing for a big. So this is important key level, but in my trading it didn't appear a lot. Then what we have, the OHLC gaps. This is how I call this. I use this, to be honest, only on GU, when I'm trading GU, so 6B contracts. And these key levels help me to find the bias, the short-term bias for London session. So I use this only for London. Yeah, and I am looking for sharp areas, or big areas where the candles didn't fill. And we can see this only on the futures chart, not on the normal candlestick chart delivered by the Forex broker, only on futures. So what I'm doing, I'm finding the good looking gap between candles just before the opening of Frankfurt or London, but it gives me confirmation what should I look at London. And so if price is below the gap, so I know that when London will open, maybe it will reach the key level, but my bias will be still short, yeah, still to the downside. So these are not typical key levels for TPs, but I use them to find, as I mentioned, yeah, the bias. So what should I be looking for? But this is short term. And like here also, nice gap, not filled before London. Then London opened with a high volume, and the bias was still bearish, yeah. And the third example also. So I'm looking for candles between 4 to 6 a.m. if in my time zone the London session opened at 9 a.m. Yeah, so I'm from Poland. In my time zone, the Frankfurt session opens at 8 a.m. and London at 9 a.m. Good, so how it looks on the footprint chart. So no confusions, do not look at these numbers. I just want to mention that these are two candles which are touching themselves just by a corner. Not with a body like here, here, and here, by a corner only. The next could be here, as you can see, just they're touching by corners here as well and here as well. So here in this screen there are 1, 2, 3 and 4 OHLC gaps. It's easier to find them on the cluster delta because the candles looks different. So it's easier for our eyes to find them. So it was also the time when I found such a thing when I was trading on MetaTrader, and you can see also here another just by a corner. So these are not a lot of candles before Frankfurt London like this, so it's really easy to spot them. So if I'm not sure on my candlestick chart if this is OHLC gap, then I'm going to footprint to confirm if really the candles are touching like this way. And in really a lot of situations, if the price is below this in the London session, it means that we can look for a short-term shorts. Yeah, because the gap means even one cluster missing data, so the move was sharp enough. So if some bearish move is sharp enough, by logical, yeah, the bears are taking control just like pre-session before the London. This is how I understand this, and it's working very well. Yeah, and this is the last example, very beautiful rejection at London. Okay, thank you guys for watching this lesson, and the next one will be about market structure. So the basics of market structure, so you will know in what I am explaining on my trades. Thanks for watching.